Thank you, Jerry. Afternoon, everybody. On behalf of Risk, we're very happy to be sponsors of RIU and certainly appreciate the opportunity to talk to you all today. It's not very often I get to stand in front of a room full of people wearing Risk badges, so welcome to the Risk family, everybody. Okay, what we're going to talk about today is quite general in the context. There's a lot of different companies present in the room today, and trying to focus in on any one aspect is always going to be tricky. So this is by nature a very general presentation, and I'm hoping to build on some of the themes that you will have heard this morning from some of the other presenters. So, of course, everyone has a disclaimer. Ours is a lot different to everybody else's because you can actually read it, and it's short. And I'm actually going to use it to just talk to you a little bit about Risk and what we do. We're an independent oil and gas advisory with the whole range of abilities that you might expect from an operator. That means we can help people with things as diverse as basin analysis, seismic interpretation, geological modelling, reservoir engineering, development and facilities, and commercial analysis. We pride ourselves on our independence, and I guess that's the essence of what we do. Is we truly believe that our independent advice can help our customers and our clients, and hopefully that's a lot of you in the room today, make their business decisions with confidence. We like to think that we tell people what they need to hear, not what they want to hear. And with that in mind, what I'm going to do now is just talk about how did we get here. And by that I mean, how do we get here in terms of oil and gas prices, oil prices hovering just below $50 a barrel. And I've got the US gas price on there. You'll see the Henry Hub price is the lowest it's been this century. And I think there's a link there. So what I'd like to do for a minute is transport us back to 2006. Why 2006? Well, the oil price was sort of similar in 2006. 10 years is a long enough time for a whole variety of things to happen, and yet it's not a long time in the context of the oil and gas industry. So if we go back to 2006, which incidentally is the year before my first ever Good Oil conference, so I wasn't here then. This is my first speaking opportunity, so I'm hoping that we can repeat it again soon. 2006, to put it in context, Pluto hadn't been sanctioned. Gorgon was still premised as a two-train development on Barrow Island. None of the other LNG projects, apart from the North West Shelf and Darwin, had been considered that much. And elsewhere in the world, he says, there we go. This is the sort of comments that people were making. The US, as you see from the graph, the Henry Hub price had a spike that winter. There was a perceived shortage of gas in the US, and this led a whole flood of activity, the majority of which was focused on LNG imports. So at this point in time, there were people starting to build import facilities into the US. I think 9 were built in the end. So you see BG, the US is destined to become a key LNG import market. They repeated that comment about 3 years in a row, by the way. So up till 2008, 2009, that was still a shared view. As you see, a lot of the other commentators were saying very similar things. Natural gas prices were going to remain high in the US, driven by a need to import LNG. And this other comment, I think, is going to be interesting to talk about a bit later on as well. Renewables were seen to be increasing, driven in the main by large hydro electric projects in the developing world. Obviously, that's not quite how things turned out. As we know, the price issue in the US drove a lot of development into shale gas. Shale gas took off, the price dropped. The shale gas successes transferred then into shale oil, and that had a major impact on oil prices as well, as we see now. And I think that's going to be something that continues into the future as well. So in 2006, we've gone back. One of the advantages of working for Risk is we have a large database and a large memory. I can actually point you to the first project the risk ever did in 1994. We still have the report and the underlying data from that report. As a result of that, we have quite a lot of info that we can call on to do this sort of stuff. So as you see, the energy use projections in 2006 were generally a steady increase, both for oil at the top. Global warming was already an issue in 2006, later became climate change. But at the time, global warming was seen to be an inhibitor on coal growth. So coal was going to be the slowest growing fossil fuel, and gas was going to catch it up in terms of market share. Renewables, as you see there, slow growth, and nuclear was going to be basically flat. The units on the left-hand side aren't actually that important, but if anyone's interested, they're actually quadrillion BTUs. Quite how large that is, I haven't really got my mind around. So what actually happened? Well, of course, they missed the GFC, which had an impact. But also, what they missed was the growth of renewables, which was a lot stronger than anticipated at the time, and not driven by hydroelectric either. It's been mainly solar and wind. And also, an interesting one that I think we should be aware of in the context of our industry, and that is that actually through all this period, coal has been the fastest growing fossil fuel. And I think that's very interesting in the context of the political pressures in terms of reduced emissions. The only place that I'm aware of that coal use has really dropped has been in the US. And that's a free market economy, and I think there's other reasons why that's dropped, not through policies and government regulations. Gas and oil both suffered a little bit in the GFC, but I have seen that steady growth that people are anticipating. So that was where it was in 2006, looking forward to around about now. In 2006, they also had some projections further into the future, and I realised that trying to predict 20, 30 years into the future is fraught with danger, and so did people back in that time. So I think the next slide we probably have to take with a little bit of a pinch of salt, but this was the energy projections back in 2006. Again, you see steady growth. Let's put that into comparison of now. We're sat here in 2016 and we've got updated projections, okay? So the first thing to notice is that renewables obviously have a much higher starting point because they've grown a lot more than people anticipated. In fact, I think if you look here, the quantity of renewables now is actually higher than was predicted 10 years ago for out in 2030. So that's how much more they've grown than people were anticipating. Coal is also on a higher starting point, and of course, oil and gas slightly lower. And there's strong growth still seen in all of them. There's two things that I think are potentially cause for concern in this room. One is that renewables growth is actually predicting on this graph at half the rate it's grown over the last 10 years. Now, my understanding of technology, having been in a technology before I was with Risk, is that once technologies get accepted and get into the mainstream, they tend to take off. And we've seen that in our own industry with FPSOs. I believe we're seeing it right now with floating storage regasification units in the LNG side of the business. And of course, we've all got a mobile phone. And 20 years ago, who would have imagined that you needed to walk around with a phone when there was one on the wall? The second one is that, again, you've heard some stories this morning about quite strong growth in gas. It is sort of predicated on the fact that coal is anticipated to slow down. Putting my environmental hat on here as a chartered environmentalist you heard earlier on, I think that's a good thing. However, like 10 years ago, I'm not sure that we can be confident that that's going to happen on its own. So the question is, what do we have to do to make that happen? What do we have to do to promote gas in particular over coal? Some other forecasts. So the one I picked was just there because it was easy to compare from 10 years ago and now. But of course, other people have different ideas. But generally, there's a fair bit of consistency in there. And the consistency comes in that renewables are the fastest growing fuel. And that's of importance for us because although they're at a fairly low base, in 10 years' time, they may well be a significant part of the energy mix. There are the BP Energy Outlook actually talks about some limitations on this, and their limitations are seen because of the intermittency of it. Again, it's something I'll come back to in a couple of slides. I'm not sure I agree with BP on this issue. They anticipate an oil price recovery and that oil demand continues to grow. I think that they're right in that transport fuel will remain dominated by oil, but the question is, how much will it dominate? And then demand for natural gas grows strongly. They had revised their predictions down, and that's driven again by LNG trade growing. There's also the element there that BP is saying that basically coal growth was going to slow sharply as well. Now, in the last 6 months, I'm not sure that we've started to see that yet, if at all. And likewise, their renewables forecast has actually been doubled last year and the year before. So BP have actually come out in their World Energy Outlook and said, we got it wrong not just last year, but the year before and the year before that as well. So they've been continually underestimating the growth in renewables. And a lot of the other outlooks have been saying the same thing. General consensus is that the emerging markets will drive growth, gas being the fastest growing fossil fuel, modest oil growth, and depressed coal growth. The IEA World Energy Outlook, which came out right at the end of last year, actually goes further, a little bit further, saying that renewables could become the largest power source by 2030. And then on the side of that, and more recently, and I wish I'd thought of this one, but it's not mine. I actually heard it from a guy who's been doing some work in America, who was over for APIA. And he talked about the green, cheap squeeze on gas in particular, which I'm going to cover in the next slide. So in looking at what might be different from those forecasts, and this is where I think we are coming from in terms of trying to get people to think about what might happen in the future. So we have some past and present game changers which we know about, and I'm going to focus on shale gas and oil. Renewables falls into that mix as well, but I think renewables at the moment is still a small part of the energy mix. Shale gas and oil have clearly had a major impact in the US, and the US are no longer playing the same game as everybody else. Conventional oil, conventional gas takes years to develop. We have generally a 2, 3 or 4 year execution time frame. Prior to that, you have studies, you have your assess phase, your select, your definition phase, then you execute, and only after that point in time do you start earning money. The US is now in a situation where when the oil price moves by a few dollars, the rigs start running again, and within a few months they can start bringing production online. When the oil price drops again, those rigs go silent again and go and get stacked. So there's a different cycle going on in the US. It's a cycle of months, if not weeks, compared to a cycle of years that we have in basically the rest of the world. And I guess the question there is to what extent can that be emulated? Now, we are helping lots of people around Australia look at unconventionals, tight and shale oil and gas. And there is opportunity out there. And certainly, I think there is the potential for Australia to develop an industry that could run on similar lines to what we see in the US. How quickly that will happen is yet to be seen. I mentioned the green cheap squeeze on gas, and that's pretty self-explanatory. Gas is obviously not as green as renewables. So it's coming under pressure from renewables in terms of being a provider of baseload power. and it's not as cheap as coal. And so if you look at it from an economic perspective, all other things aside, there's potentially a rationale for countries to move to a mixture of renewables and coal for their power generation, at least in the medium term. Again, putting my environmental hat on, I think that would be a bad thing. Not only does coal-fired power generation emit twice as much CO2 as gas-fired, it's also not as flexible, so you can't turn it on and off. You have to keep it on a base load. So the actual implication of having a mixture that's mainly coal and renewables rather than gas and renewables is that you're probably going to be emitting between 3 and 4 times as much. So I see gas as the ideal partner for renewables because it can be switched on and off quickly and because it's the cleanest of the fossil fuels. But we need to promote that positively as an industry. We need to advocate the use of gas in the energy mix to complement and supplement renewables. And how do we do that in the face of the moratoria on fracking that are popping up around the country at the moment? There's about 8 studies that I'm aware of, a lot in Australia, 4 in Australia, 1 or 2 in New Zealand and 2 or 3 in Europe, which have looked at the impact of fracking and the risks associated with it. Not one of them has come out in support of a moratorium, and in fact all the ones that made some recommendations and scientific rationale outcomes from their studies suggested that the risks associated with fracking are manageable, and as long as you adopt best practices, and in particular around well integrity, you can manage the risks associated with fracking. So how do we get the general public, who've now accepted climate change science, to accept the same sort of scientific explanations on fracking? I'm not sure, but I think it's something we need to promote. And then renewables. I mentioned renewables as a game changer. Power storage in particular could be a game changer to that whole demand profile. It would result in demand for both oil and gas and coal slowing much more than is currently anticipated by some of these forecasts. And that would then put further price pressure, prices remaining lower in the longer term. So, in conclusion then, what if we are seeing something where we may well be in a price situation which is longer for lower, or maybe lower in the complete long term, what do we do about that? Well, there's going to have to be continued focus on costs. We see that all projects now and future projects are going to need to be robust to continued low prices. And portfolio rationalisation and focus on core strengths is occurring, we think. There seems to be a recognition of limitations of viability by many companies, and you're seeing that with the shelving of LNG projects, the deferral of marginal oil field developments, and this continued focus on cost reduction. Again, there appears to be a re-emergence of end-of-life transactions. Larger organisations with ageing assets that they can't make money out of are now looking to divest things. And that provides an opportunity for smaller, lower-cost operators to take on those things that the large organisations can't make money out of. And the question there, in my mind as well, is how transferable is that into development opportunities? So are there opportunities for smaller players to get into the market and do things that the larger players simply can't do? We believe there are. And finally, opportunities for new players. We've just heard already today some people talking about domestic gas opportunities that are going on. We also believe that translates into the LNG scale, with LNG markets, new LNG markets opening up, smaller scale opportunities there, particularly with the advent of the floating storage and regasification units, which are allowing this diversification of geography to occur within the LNG industry. And we also know that LNG buyers are looking for smaller and shorter term contracts, and that opens up possibilities for smaller scale development options, and they might be land-based or floating based for LNG. I'm out of time, so thank you very much for your attention, everybody.